Looks like everybody's here except Joshua. He emailed me Monday and said that he fell asleep watching a movie before class and didn't wake up in time. So we'll hope he makes it today. I have been grading the case studies. I get about 1 or 2 done a day. So I've got, I think, 3 more to go. Might get one done in the afternoon today. If not, I'll be working on them tomorrow. So is everything going all right? As good as possible in the circumstances?
As good as possible.
Yeah. I'm opening up Canvas for me to look at. Final paper draft was due today, but if you didn't get it ready, I can understand in the circumstances. Tara, I don't know what happened before that you didn't get the copies when I graded it. I'm pretty much in a habit of, after I finish grading it, putting the score on Canvas and immediately emailing the graded copy and the rubric, but I messed up with yours somehow. So let's see. We were looking at the week 7 PowerPoint. Hey, he's awake. So I'm going to go through that slideshow now. And this is the slide where we left off. I believe it was a list of 5 main categories of types of financial statement frauds and tricks. So let's go on and look at them more in depth. Fictitious revenues is the first kind. Corporations might lie about the amount of revenue that's earned. We saw that WorldCom made up entries to record extra revenue. Actually, a lot of what they did was capitalizing expenses, so they weren't recording extra revenue as much as recording less expense, but sometimes they just made up entries, recording revenue that they never earned. In the Crazy Eddie fraud, initially they hid revenue to lower taxes, and then after they went public, they overstated revenue in order to boost the stock price and attract investors. Kulzik, who had the list on the previous slide, listed 3 different ways that companies have created fictitious revenue. And first method is fabricating revenue, just making it up, following the WorldCom example of simply entering into the books revenue that never actually was earned. Second, inadequately providing for sales and returns would overstate revenues. So they overstate revenues by understating the expected. Sorry, I had stuff stuck on the bottom of my mouse that was making it sticky. If you understate the expected sales allowances and returns and allowances, then that will overstate the net revenues. And then third, improperly recording sales as revenue when not all of the legal or accounting conditions for a sale were met. A lot of this would have to do with transactions at the end of the year. And that's why when you had the auditing class, they said that timing is something that the auditors really have to take a careful look at, especially entries that are recorded near the beginning or near the end of the year. So that goes into the second kind, timing differences, which involves deliberately recognizing revenues or expenses in the wrong time periods. It's often done in order to smooth income, which is done in order to make the company's earnings look more stable. Income smoothing and some of the ways it's accomplished is discussed in more detail in Learning Objective 2. So we'll come back to that. Hidden liabilities and expenses. Recall that Enron hid liabilities in its special purpose entities. How do they do this? The company might just simply omit liabilities and expenses in order to improve the appearance of its financial statements, or it could deliberately understate them. For example, a company might deliberately understate its estimated warranty costs and the associated liability. WorldCom understated expenses by improperly capitalizing them. A fraud we'll look at later, Waste Management committed a fraud by overestimating the useful lives of their garbage trucks, which meant that the depreciation expense they recorded each year was less than it should have been. Improper disclosures. Significant material events may not be reported properly or even at all. Management fraud, after all, is rarely reported voluntarily. Other things that are a concern include illegal insider trading may not be reported. Martha Stewart was jailed after perjuring herself in a trial related to insider trading. That happened when her stockbroker got an inside tip that stock that she had invested in, which was a pharmaceutical company, had risen in price because they had come up with a new drug that they expected would be very useful for cancer, I think. I can't remember what it was for, but it was going to be very profitable for the company. And her stockbroker found out through inside channels that the FDA had denied its usefulness. There was something wrong with it and weren't going to let them use it. And once that became public, the price of that stock that she had a lot of shares in was going to drop. So he told her to sell it right away. And I think that she didn't actually do insider trading because he hadn't told her that it was inside information. He just told her to sell it. But during the trial, when they were trying to ascertain the truth about it, she lied and said that he never told her at all. But they had evidence, documentation that he had. Related party transactions may not always be properly reported, and changes in accounting methods or policies might not be reported properly. Improper asset valuations. Management that's bent on committing fraud may overstate its assets. Some of the assets likely to be overstated include inventory. And how do they do that? The calculations of ending inventory may be fudged. Losses for obsolescence and declines in market value may be understated. Accounts receivable are sometimes overstated by deliberately understating estimated losses and allowances. And some companies have fraudulently created fictitious receivables. Fixed assets can be overstated by underreporting depreciation expense or by not writing off impaired assets. Business combinations may not be accounted for properly, and as a result, goodwill, for example, could be overstated. And some companies might not report the impairment of goodwill. I thought that it was obvious that these were unethical. We didn't need to add a Bible verse to prove that. Earnings quality. From the perspective of investors in the capital markets, earnings quality means that reported earnings accurately represent current operating performance and aid in accurately forecasting future operating performance. In other words, the financial statements should accurately report the underlying economics of the business. And that could be a confusing phrase, because the first time I heard earnings quality, I thought it meant strong earnings instead of low profits. But that's not what it means. We're not talking about the strength of a particular company, its profitability, or its exposure to debt, but what we're talking about is its reporting. Earnings quality does not imply high earnings. This relates to FASB's conceptual framework that says the financial statements should be reliable and relevant. So earnings quality, if they're quality, then the financial statements would be a clear, transparent window that shows the company the way it really is. Comments on that?
No.
Okay. All right. Threats to earnings quality. Two things threaten it. First problem that can create poor transparency in the financial statements is caused by GAAP that is less than optimal. If the accounting rules are bad, then the financial reports that use them will not give appropriate information to investors. Making sure that GAAP is appropriate is the concern of accounting theory and research and of the governmental and private sector regulatory bodies. Second threat, fraudulent and devious reporting. Some companies either deliberately violate GAAP or find loopholes that allow them to slant their reports. Management may not be principled and can intentionally bias accrual estimates within GAAP in order to meet performance targets. This is the concern of our course in accounting ethics. Suboptimal GAAP, that would be a concern of an accounting theory course. We used to have that class, but we don't anymore. Investopedia defines earnings management as the use of accounting techniques to produce financial reports that may paint an overly positive picture of a company's financial position. Income smoothing is one of the more common purposes of earnings management. Investopedia defines income smoothing as the use of accounting techniques to level out net income fluctuations from one period to the next. Companies indulge in this practice because investors are generally willing to pay a premium for stocks with steady and predictable earnings compared with stocks whose earnings are subject to wild fluctuations. So hopefully, when you took business finance, you not only learned about the beta, but you still remember it. It's a way to measure the volatility of a stock, that is, how much its stock price fluctuates. The more it fluctuated, the less attractive the stock was as an investment. And a company with volatile earnings and stock prices is undesirable to investors who see it as risky. But investors are willing to pay a premium for stocks that have a steady and predictable earnings stream. A steady increase each year over a period of time is the ideal thing that a lot of investors are looking for. Okay. I'm looking for the function to click on for the whiteboard, which I don't see now. Oh, okay, it's a part of the share screen. Are you seeing what I'm drawing here?
Yeah, we can see it.
Okay. Okay, so what they're just talking about, this slope of earnings over time is the kind of thing that stock investors really like. Steady increases in earnings over time. Now, this is what they really don't like. Because if you were right here at this time, based on the past, you have no idea whether that stock price is going to turn around or not. And it's really hard to predict future earnings when a company's earnings fluctuate that much. So what's going to happen then is that the stock price of this company is going to fluctuate also because of the fluctuating earnings. So what a company might try to do is this year, they might not recognize some of the expenses, minimizing the loss. This year, they might not recognize some of the revenue. And what that's going to do in the long run is kind of smooth out their earnings. which makes it look a lot better than it actually is. And that's the concept of earnings smoothing. Comments on that?
So that's considered unethical, correct?
There's a debate about it. Some people who are more libertarian and free market think that it might be okay because it would mean that the shareholders actually would benefit from steadier stock prices. But most people think it's unethical. And the problem is that frequently, whether it's ethical or not, the way they accomplish it is by falsifying financial statements. And so regardless of your motive, that's going to be unethical. Okay, so here are ways that companies manage their earnings. And this is just a few of the methods that have been used. And after we go through the list, then we're going to break them down into detail and unpack them. So accelerated recognition of revenues. You can recognize revenue before it should be, especially if you're anticipating that you will earn it. Delayed recognition of expenses. Cookie jar reserves. Big bath accounting and shrinking the ship. So accelerated recognition of revenues. If a company doesn't want to report that the current year is relatively unprofitable, its management may try to recognize some of the anticipated revenue of the next year in the current year, essentially counting their chickens before they're hatched. This could be done by inappropriate estimates, by altering the dates of transactions, by channel stuffing, or other tricks. Regardless of whether or not a trick might be acceptable under GAAP, the intent to mislead investors would, of course, make it unethical. So delayed recognition of expenses. The motivation is the same, to smooth earnings for a poor year. If management expects next year to be better than this year, then some expenses could be understated this year and overstated next year to smooth earnings. This can also be done by several different methods. A manufacturing company can overproduce, deferring the recognition of fixed costs, which are absorbed into the cost of finished goods inventory until the next accounting cycle. Current expenses could be deliberately underestimated. The recognition of asset impairments could be delayed. Again, even if the trick is allowable under GAAP, if the intent is to deceive, it's unethical. Cookie jar reserves. The Investopedia website has a good description. A disingenuous accounting practice in which periods of good financial results are used to create reserves that shore up profits in lean years. Cookie jar accounting is used by a company to smooth out volatility in its financial results, thus giving investors the misleading impression that it is consistently meeting earnings targets. Regulators frown on the practice since it misrepresents a company's performance. The term may be derived from the fact that a company which employs this practice dips into the cookie jar of reserves whenever it feels like. But the company may have to pay a steep price if it's caught with its hand in the proverbial cookie jar. So what you should think of it this way is that they've got a jar of cookies, but that represents accounts where they are somehow not recording all of their revenues. So when they need them, they can open the jar and voila, some revenues appear because they didn't recognize them previously when they should have. So it's an income smoothing technique in which a company would deliberately understate its revenues in profitable years and use accounting tricks to save up the unreported revenues until a bad year. In the bad year, they would then report the revenues that they had not been reporting in the past. Big bath accounting. This is a rather bizarre strategy in which a company overstates losses in one period, figuratively taking a bath in red ink, because red ink is symbolic of losses. Back when accounting was done manually, expenses and losses were sometimes written with a red ink pen, while assets and revenues were written with a black one. So red ink came to symbolize losses and deficits. So why on earth would a company want to deliberately overstate its losses? Investopedia has a good description of this as well. The big bath is often implemented in a bad year to enhance artificially next year's earnings. Management may be motivated by hubris. New CEOs sometimes use the big bath so they can blame the company's poor performance on the previous CEO and take credit for the New Year's improvements. Seems to me like a lot of presidents do that. Or management may be motivated by greed. The big rise in earnings might result in a larger bonus for executives. Another way it could be related to greed and bonuses is if they figure that they're losing money this year anyway, they can't get their bonus, they'll record even bigger losses so that next year some of the expenses that were recognized this year won't be recognized. Next year will be more profitable and they're more likely to be able to get a bonus next year because they knew they couldn't this year. How it could work. For example, if a CEO concludes that the minimum earnings targets can't be made in a given year, he or she will have an incentive to move earnings from the present to the future, since the CEO's compensation doesn't change regardless if he or she misses the targets by a little or by a whole lot. By shifting profits forward, by prepaying expenses, taking write-offs, and or delaying the realization of revenues, the CEO increases the chances of getting a large bonus the following year. This cannot really be considered as honest and ethical reporting. Next method is shrinking the ship. A company could boost its earnings per share by manipulating its treasury stock. If the earnings per share looks as though it will be a little shy of a promised target, the company could purchase shares of its own stock to increase its earnings per share. Recall from Principles 2 and Intermediate 2 that treasury shares are sort of dormant. Since they are not held by outside investors, they do not have voting rights, do not participate in dividends, and are not counted as outstanding shares when earnings per share is calculated. Dividing the same net income by a smaller number of shares increases the earnings per share. Again, this would be both deceptive and unethical. Materiality issues. Can fraud be immaterial? Recall that the concept of materiality used in previous courses was an item large enough or significant enough to make a difference to investors. More specifically, FASB's definition of materiality says it's something that influences or makes a difference to a decision maker. FASB and the SEC and court decisions insist that materiality should not be expressed as a quantitative amount such as a set percentage. They don't like the idea of a cookbook amount because professional judgment is necessary. So FASB said magnitude by itself, without regard to the nature of the item and the circumstances in which the judgment has to be made, will not generally be a sufficient basis for a materiality judgment. The board's present position is that no general standards of materiality can be formulated to take into account all the considerations that enter into an experienced human judgment. If judgment is needed to determine materiality and not a quantitative or mathematical threshold, then what are the qualitative factors that are indicators, the kinds of things? FASB addressed the issue and said a numerical threshold such as 5% may be useful for a preliminary assumption, but experienced human judgment is needed. And the next slide has a list of the factors to use. On the right is a screenshot of the list prepared by the SEC. Each item would require careful, critical thinking and analysis by a professional accountant, and auditors need to vigilantly look for them. So materiality has to be taken into consideration when the number is made from a rough estimate. It's harder to say that 5% is the cutoff for materiality because various ways of doing the estimate could give numbers that are quite different from each other. And yet they all might be based on valid assumptions. Now, whether the misstatement masks a change in earnings. So what if you had a rule of thumb that materiality was 5% of assets on the balance sheet, and you found an accounting error that was 1%. But that 1%, well, no, we need to do that for the income statement. 5% of net sales. And you found an accounting error that was 1% of net sales, and yet that 1% changed the company's net income from a loss to a profit. That makes it much more significant, even though it's a small amount. Whether the misstatement hides a failure to meet analysts' consensus expectations for the enterprise. So if the stock market brokers and investors, analysts, and so on were saying that earnings per share in this quarter should have been $1.25, and an error was made that changed it from $1.24 to $1.25, you might have to think that that was done deliberately, and therefore it's material. If the misstatement is in their core operating company, that is, if they have multiple operations and segments and subsidiaries, and the one that's the most important is the one that has the error, then that makes it somewhat more significant. If the misstatement affects their compliance with regulatory requirements, that makes it much more significant, even if it's small. If the misstatement affects their compliance with a loan covenant, you have to think if they made this error on purpose, because if they didn't make the error, they would have violated one of their loan covenants, then that makes it significant. So those are many of the different kinds of examples. The PCAOB says that the same conceptual definition of materiality that applies to financial reporting applies to information on internal control over financial reporting, including the relevance of quantitative, which is math, and qualitative type considerations. KPMG flubbed it. In 2004, KPMG agreed to pay $10 million to settle Securities and Exchange Commission charges that the firm and 4 accountants engaged in improper professional conduct, leading to repeated audit failures at client Gemstar TV Guide International, Inc. What happened and why this relates to materiality is on the next slide. So when I was a kid, you went to a supermarket and they had a magazine rack, and one of the magazines that was always there was a TV Guide. And it listed for you for the upcoming week all the stations that you got on television and what their programs would be each time of the day and night for the next week. They began to become less useful when cable was introduced. So they started adding supplements that had the major cable channels. And then now that we've got online stuff where you can just look it up on the internet, and people are streaming and pretty much ignoring scheduled times, TV Guide may be having a rough time as a continuing business. I don't know, do any of you ever use the TV Guide? Or do you even know, have you encountered it before?
I know what a TV Guide is.
I,
I'm older.
I heard Tasha, but it wasn't loud enough to understand.
No, I said I know what a TV Guide is, but I'm older, so.
Yeah.
We used to use it all the time growing up, so.
Yeah.
Okay. Let's go back, take a look, and finish this here. The SEC alleged that from 1999 to 2002, KPMG and its auditors should have known that Gemstar was improperly booking $152 million in licensing revenue and $60 million in ad revenue, and that KPMG's auditors repeatedly relied on Gemstar management's representations, even when those representations were contradicted by their own audit work. So they would audit something, find a number, Gemstar would tell you, oh, that's wrong, trust us, and they did. How does this relate to materiality? The SEC alleged the auditor's materiality determinations were unreasonable and that they were based on a quantitative analysis and failed to consider whether the revenues at issue were qualitatively material. Thus, when some irregularities were found, the KPMG auditors determined that they were immaterial because of their size. They thought that they were too small to really matter. The KPMG auditors missed the fact that the misstatements, although small, were for revenue related to business lines watched by securities analysts and had a material effect on the valuation of Gemstar stock. In addition to the $10 million fine, which was levied by the SEC, but paid to harmed Gemstar shareholders. The SEC sanctioned 4 auditors on the case who were denied the privilege of appearing or practicing before the SEC for various periods of time. Okay, so our 40 minutes is about up. And so let's stop the share here. See if there's any questions. Last time I checked, there were 1 or 2 cases still not submitted, so hopefully you can find the time to work on those. I haven't checked today or since late yesterday afternoon. I have posted 2 quizzes, right, on Canvas. Has any of you taken both of them yet? I didn't
I
have,
only took A.
you only took A?
I'm taking B today. I took A yesterday. I'm taking B today.
So it
Same.
worked okay when you took it?
Yes, yes, it did.
Okay, good. That's what I really needed to know.
Yeah, it did good.
When I'm setting them up to randomly select questions, it never works the first time. And when I check, the quiz is blank. And then I have to fiddle around because the instructions that are posted by Canvas and how to do it aren't complete for some reason. And then I get what I think looks correct. Until somebody actually takes it, I won't know. All right, good. And I hope you thought it corresponded pretty well with the study guide, so no surprises on it. All right, so if you got anything you need, then you can contact me by email, and I'll see you again on Friday. Take care, be careful. See you then.